The International Monetary Fund, IMF, reiterates its position on how St. Kitts and Nevis and other countries with a citizenship by investment program ought to manage the revenues from the program. Save, save, and save. The latest recommendation comes from Acting Director of the International Monetary Fund Western Hemisphere Department, Nigel, at the department's press conference during the IMF annual spring meetings on Thursday. He was asked the question by SKN Vibes Jermaine Abel, who is providing coverage of the meetings.
So these have been a very important feature of the region, the Caribbean, and particularly for St. Kitts. And we're generally very supportive of those. They've generated an important amount of revenues for the country, and those revenues offer the potential to be deployed in a range of areas, and there's lots of needs, including, as you mentioned, to some extent, social spending, but also the region is very prone to hurricanes. There's a lot of need to make the infrastructure more resilient, to adapt to climate change, and also to decarbonize the economy, because the countries are very exposed to big shifts in global fuel prices. So I think on the whole, the CBI program has been important in these countries. I would point to two things, thinking about how to structure them. First of all, this revenue is very volatile. So I think you have to be very careful about spending that revenue in a lumpy way. So we prefer a system where the CBI revenue is basically saved, and some spending is derived from that revenue basically through the stream of income that those savings creates. That's a more stable system rather than having kind of stop-go spending linked to depending on how much CBI revenue you get in a year. And I think it's really important to maintain the integrity and actually to improve the integrity of these schemes, given their reliance on sort of recognition by some of the larger economies. And in that, the ECCU is moving ahead, actually. I think recently they had a press release that they're moving ahead to improve the integrity of these schemes in conjunction with some of the larger economies.
Meanwhile, Mr. Chalk's outlook for tourism-dependent economies was quite encouraging.
I think you will have seen in our global forecast, we think the U.S. economy is going to slow, but it's still growing pretty strongly. And one of the aspects that's going on in the U.S. economy right now is there's a shift from goods consumption to services consumption. So even though the whole economy is slowing, that shift from good to services is actually good for the Caribbean. It's good for tourism-dependent economies because Americans are traveling more, they're investing more in leisure activities and so forth. And so that's proven, I think we've seen across the region, the Caribbean, that's proven quite a big boost to the economies. We don't see a recession, so we feel that potential flow of tourism is going to be maintained. But I think it would be prudent for the countries in the region to think about what would they do if it were to slow, if the U.S. were to slow down, if interest rates in the U.S. had to go higher in order to bring down inflation, not as a baseline scenario, but more as contingency planning in case the U.S. were to slow down. And the same is true for Europe as well, because they're very reliant on Europe.
The IMF department chief noted that growth in the Latin America and Caribbean region was surprisingly on the upside in 2022. After growing by 7% in 2021, Latin America and the Caribbean grew by a respectable 4% in 2022, Mr. Chalk said. Output and employment are now comfortably above pre-pandemic levels, he noted, but cautions that growth is expected to decelerate to 1.6% this year, although the IMF expects most of the region will avoid a recession. Audrey Huey, SKN Newsline.